This evening's session relates to calculating capital gains on unit trust and OEIC investments. It relates to the UK HMRC tax rules. And during the session we will first of all discuss how you match buy and sell transactions, unit trust transactions, to calculate your gain. We will then discuss notional distributions and equalisation payments and how they are handled and what they mean. Lastly, we will have some worked examples both on paper and then on TIMETOTRADE, so you can understand how you input these types of transactions into TIMETOTRADE and how you can understand the results. To begin, when dealing with unit trusts or OEICS, or collectively they're called funds, to calculate gains or losses, you apply what are called share identification rules. So the rules that you normally apply to calculate gains and losses on normal share transactions are applied to unit trusts. And for the year ending 5th of April 2008, the share identification rules are: firstly, you match any disposals against shares acquired the same day. You then identify any shares bought within 30 days in the future from the time that you sell. So if you sell some units today and within 30 days in the future you buy some units back, then the purchase that you make 30 days in the future is matched with the disposal today. That is called the bed and breakfasting rule. The third rule is the most commonly used rule then, is last in first out. So if I sell some units today, and if I bought those units, shall we say, I bought them a week ago and then a month before that, then I will match the disposal against the cost of the units bought a week ago, and if there's any units left, then the cost of the units bought a month ago. Thereafter, you have what's called a Section 104 holding, which is for units purchased between 1982 and 1998. And all of the units and the related cost is put into a single pool where you have indexation, etc. And thereafter it goes back to a last in first out basis. If you held any units before 1982, you had the right to use the value of the units in March 1982 as the actual cost. The key thing here is that up until the 5th of April 2008 you have to apply these rules in the listed order to calculate gains and disposals. However, as of the 6th of April 2008 the rules have changed, but we'll cover them next year. But these rules should still be applied for the tax return due on the 31st of January 2009. So in this example we will walk through a situation where, firstly, shall we say, on the 1st of January 2006, a person bought 10,000 units at 300 pence each. The total value of those units, therefore, the cost was £30,000. We shall then say that on the 1st of May, over a year later, another 5,000 units were bought, this time at 200 pence. The resulting cost then was £10,000. Now on the 1st of January 2008, as in just before the end of the last tax year, which is April 2008, we should say that this person then sold 15,000 units. So at that point in time they sold all the units they had previously acquired, okay, and they sold them at 200 pence. So in this case they broke even, and in this case they made a loss, okay. So in theory they made a loss at that point in time, and the disposal proceeds was £30,000. However, on the 25th of April we should say that the person decided to buy the units back. So they bought, or a portion of the units, so they bought in this example 5,000 units back at 100 pence, and they spent £5,000. So when it comes time to calculating your gain or loss on these transactions, you first of all have to match the transactions bought within 30 days of the disposal. So the disposal date was 1st of January, the 25th is within 30 days in the future, so you have to match these units bought to the units sold on the 1st of January. In this case, there was 15,000 units sold, 5,000 units bought, so we have to then match another 10,000 of the remaining units. Okay, so down below we'll see the breakdown as follows. 5,000 units acquired on the 25th of January are matched with the disposal on the 1st of January. Thereafter, 5,000 units acquired on the 1st of May are then matched with the disposal on the 1st of January. So we've now disposed of 10 out of the 15,000 units, and lastly then 5,000 out of the 10,000 units acquired on the 1st of January are matched against the disposal. If we now take a look at what is the actual gain, if this person had not have bought back the units within 30 days, they would have made a loss, okay? Because they sold at 200 pence and they'd acquired the units at 200 pence and 300 pence, a higher cost in the past. However, because of the bed and breakfasting rule in this example, first of all we match 5,000 divided by 15, so you take this total cost, okay, and you apportion it against the 5,000 units bought on the 25th of January, okay? Then you take away the cost of those units, okay, and you're left with a gain. So basically, the units were bought at 100 pence, they were sold at 200 pence. There was a gain, okay? The next transaction that is matched is 5,000 units that were bought on the 1st of May 2007, and again you apportion the disposal proceeds, okay, the £30,000 disposal proceeds. So 5 over 15 is a third, by 30,000 is 10,000. So 10,000 take away the cost of those units, okay, is 0. So there was no gain or loss on that transaction. And lastly, 5,000 units out of the 10,000 units bought on the 1st of January are matched with the remaining 5,000 units from the 1st of January 08. So we have 5,000 over 15 by 30,000, so a third of the disposal proceeds, okay, take away a half of the cost of the original shares. So we have 5,000 shares matched out of a total of 10,000 units, sorry, we have 5,000 units matched with a total of, divided by a total of 10,000 units that were bought on the 1st of January 06. Okay, so £15,000 of cost is apportioned. That results in a loss of £5,000. So the total gain in this situation was 0.